Good afternoon, ladies and gentlemen, and let me introduce the panel for this talk on investing to retire early. We have Moira O'Neill, the renowned financial journalist, writing and speaking on money and investment for publications including the FT, Investors Chronicle, Money Week, The Times and Daily Mail. Moira will be moderating the panel. Next we have Helen Morrisey, Head of Retirement Analysis at Hargreaves Lansdown, with a distinguished career in financial journalism, specialising in pensions. Then we have Craig Rickman, Personal Finance Editor with Interactive Investor, a financial journalist with credits including the Financial Times and formerly a financial advisor. And last but not least, we have Malvee Vaja, a chartered financial planner with Rathbones and a fellow of the Personal Finance Society. Thank you all very much.
Thank you very much. So, if you're in this room, I gather you're very keen on retiring early, or you know someone who is, or maybe you're already retired and you just want to come for some tips. Really, we're going to try and give you as much as we can. We're going to whiz through a lot of information. I don't think we're going to have time for questions at the end, but we'll all hang around for a few minutes afterwards if there's something specific you want to ask us about your circumstances, and we'll do our best so we're not all qualified to give financial advice. Pensions really is that is what gets us to retirement, and there's been an awful lot of political tinkering around the edges with pensions in recent years, and this gives people, I suppose, a bit of a lack of confidence around it. But also the rumour mill is very potent, and a lot of people have been taking action on rumours, which we really shouldn't be doing, but it's understandable. And you know what could be happening. So let's have a think about that to open up. Helen, you look at these kind of issues all the time. I mean, what are the particular changes that are worrying people at the moment?
Yeah, it's a really good question, Moira. I mean, I have covered more budgets, spring statements, autumn statements than you could shake a stick at over the years. And I must admit, I've never known the rumour mill run quite so red hot as it has done over the past year. And it very much kind of started in the run up to the last budget with a lot of rumours, particularly around tax-free cash, and whether the amount that you could take was going to be further pulled back on. I spent a lot of time speaking to the press, trying to get across to people, not to take knee-jerk reactions. People were worried. They were saying, well, if it's going to be restricted, should I just take it now? And there's all kinds of unintended consequences that could come across by doing that we were trying to get across to people. You could get hammered for tax. So a lot of people thought that they could take the tax-free cash and then just reinvest it back in their SIP if the change didn't happen. Some people thought that they could, for instance, rescind their directive to do it. All kinds of things happened after the budget that meant that there were some people who took the tax-free cash and actually regretted doing so because they were left with this money that they never intended to take, and they're like, right now, what do I do with it? So tax-free cash, those rumours have never really gone away. I am starting to get more journalists asking me about what I think is going to happen to tax-free cash. There's also things around the annual allowance, and many of you will remember when the annual allowance, the amount that you could put into your pension and get tax relief, it used to be over £250,000 really not that long ago, and it's been progressively whittled away over the years. Then the last government increased it to 60,000, and then which was really kind of welcomed by many. But now there's lots of rumours saying, are they going to reduce it again? And again, these kind of rumours, they just undermine confidence in the system. What I always say to people are, pensions are a long-term game, and you should take a long-term approach to them. Try not to react to short-term rumours, because you could end up in a position that you would prefer not to. I always say to people to try and plan for the tax regime that you are in right now, and we continue to kind of engage with government. I know that you guys at II do as well, to make sure that the government does take a long-term view, the importance of a stable tax environment for people to try and do the right thing, to plan for their long-term future.
I mean, pensions are still the best thing you can use to invest for retirement. They're incredibly tax efficient, and it's very hard to beat what they offer. So I think everyone should be taking full advantage, whether you are, if you're in the workplace, you'll have auto-enrolment. If you are a freelancer, self-employed, there are still options for you to contribute to pensions too.
Yeah, I think that's a really good reason why it's important for the government not to continue to meddle with the pension tax system, continue to erode the tax perks. It could just put people off saving for retirement. I mean, I think you look back to 2024 and the sort of goalposts shifting. We saw the lifetime allowance was officially scrapped. Yeah. And then savers reacted to that by engaging in certain behaviours. And then 6 months later, we had the proposal to bring pensions into the scope of IHT. So it's so incredibly hard for people to plan when these things are changing. And what's in the lead up to this budget, again, it's only speculation, but it's not helpful for people, especially in the previous budget. There were big changes to particularly to inheritance tax, capital gains tax. So we would hope that there aren't going to be any big changes coming.
Well, seeing as you mentioned inheritance tax, let's go there, because I was going to save that till the end. And there was a specific panel later on this afternoon on inheritance tax and pensions for those of you who want to do a deep dive. But just to sum up, Malvee, perhaps you could sum up what's happened there.
Yeah, I think the changes announced is actually really knee-jerk reactions. People are spending a bit more. They are taking their tax-free cash out and actually, spending more. That whole thing of leaving the pension be. That was what the advice that we gave to a lot of clients was: leave your pension be, because it was outside of the IHT framework. That's totally spun on its head now, and we're finding a lot more clients withdrawing money from their pension to spend, and I think that is the right way to go about it.
That's what a pension is for.
Exactly.
A pension is there to give you an income in retirement.
And if you're doing the right things planning wise, you should, speaking to a financial planner, doing some cash flow planning as well, understand what you can actually spend, because it's probably a little bit more than you think. Spend that. There's no inheritance tax on gifting out of income. The 7-year rule does not apply to gifting out of income. As long as there's a pattern there, it's all good. So that's one of the ways that we've been talking to clients, having those conversations about: are you using your annual allowances? Are you gifting out of income? So that's a lot easier to do than the big gifts and big chunks of money to gift away.
Yeah. So these are potential worries for people who have got there, they've saved all their lives, they've almost got surplus income. Lucky them. Hopefully you'll all be in that position in this room. But let's talk about what retirement actually means, because we've got a panel about retiring. Retirement has changed as a concept. It's not just this cliff edge anymore. It's very, very common that people ease into it, for example. Yeah. Helen, what's your experience in this?
So I get asked quite a lot by journalists, about stories that they're working on and what you need to do to retire early. And, it's a really, really interesting concept because, for a start, we don't know how long we're going to live, and we tend to look at our grandparents and say, right, grandma, grandpa lived till they're 75, that's going to be the same for me. The chances are it won't. And if you are also looking to retire early, if you're looking to go at 57, for instance, you have to save so much more in less time to try and make up that kind of income gap. The other thing that I also say to people is that all-important state pension. The state pension is the backbone of the vast majority of people's retirement income. There are very few people, you have to be extremely wealthy to get by without the state pension making an impact. And if you are looking to retire early, you do really have to cater for the fact that you could be retired for 10 years without that state pension, which you know is currently just a shade under 12,000 per year. So whatever you're saving, you have to make sure that you're trying to make up for the absence of that state pension as well.
Definitely, and the state pension age is now under review. We have got a pensions commission being put in place, so we can only expect that state pension age will go up, unfortunately. Yes, so retirement, Craig, you do a big survey on this about what people feel about it. I mean, what have you found? Are people wanting to retire early more? What do they think of retirement? What does retirement mean? You know.
Yes, it's a good question. I mean, I guess it's this whole concept of financial freedom, isn't it? Financial independence. That you've got enough money and other assets that you don't have to work. You can choose to if you want to, but you don't have to. But that can mean vastly different things to different people. I mean, if you took, the real extreme end, the FIRE movement, those who want to save and invest really aggressively in their 20s and 30s. And retire in their 40s or early 40s. That's one way of looking at it. Others, want to continue working throughout their lives, but they might want to wind down work, for example, when they get into their 50s. So start to phase in. I mean, it's so nuanced, and it means such different things to different people. And I think that's the key for anyone when they're planning, isn't it? To think about what does this mean for me? What does early retirement look like, or what does retirement look like?
So it's not necessarily about the financial goals, it's about the sort of emotional, what am I going to do, what's the purpose of this new phase of my life, I suppose. Yeah,
and I get that. I mean, they're sort of entwined, aren't they? Because if you do want to wind down work, then you are going to need money from other places to do it. But it's trying to think about, how do I want my life to look now, and how do I want my life to look in the future as well. So it's trying to work out, what that means to you and how to strike that balance.
Yeah, we've mentioned that state pension age is going up. Now that means the private pension age is likely going up too, because they are linked together. Private pension age tends to stay 10 years before state pension age. How do you plug the gap, Malvee? What clients doing?
It is about maximising those annual allowances, the pension annual allowance, your ISA annual allowance as well. So, I'd say it's doing both the pension and the ISA, because you can, as you said, you can start taking money out of your pension from 57. It's going up, but if you're planning to retire in your 40s, then ISA's the only other option to go for, and making sure it's invested in the right way as well, because you're not going to get the growth at the other end if you haven't done all the right things of investing and starting early. So it's about, what does that retirement look like for you? What age? What do you think you're going to be spending? And the thing is, it's a long time. So people retiring now have got a 1 in 4 chance of living to their 90s. That's almost 30 years in retirement. It's almost as long as most people's careers. And for that long period of time, if you're not earning anything, you've got to make sure that you've done all the right things at the other side in terms of saving.
Could I just add to that as well? There's the whole issue of, as you say, you can plan for what you think your retirement's going to look like, but there's also that issue of healthy life expectancy as well, isn't there?
Yeah.
I spend a lot of my working life with my head stuck in a spreadsheet looking at this stuff, and it does make for pretty grim reading. In the you might look to be living until you're 80-ish, but healthy life expectancy currently hovers somewhere in the early 60s. It's about 62. And that kind of means that, for some people, they will be able to continue to work. But for many others, particularly if you're doing like a manual job or something like that, you have to kind of prepare for the fact that you might not be able to get it. So almost retiring early might almost be forced on you to a certain extent.
Yeah, but then there's also a lot of people who are, opting for that hybrid retirement as well. So I think the current framework allows us a lot of choices. You can retire early if you want to, but we were just talking earlier. My dad turns 70 today, still working, and he's likely to continue for at least another 5-10 years. Who knows? But there are a lot of people who are doing that, working part time or taking on non-exec positions, working a couple of days a month. There's lots of options around that if you've got good healthy lifestyle.
But I mean, when we talk about early retirement, how early is early? Because a lot of people will think early is retiring a few years before state pension age, but then there's a whole, ecosystem devoted to FIRE, which is financial independence, retire early, which are people retiring at 40 and living very frugally in order to do that. But there's vast differences between the ages at which you may aim to retire. Malvee, what's your experience of that?
Well, in my experience, a lot of clients do tend to do the hybrid style. There are some that will have the very few that I speak to that have a definite date in mind. It's very much a case of going to try and keep working or try and taper down to a certain extent. I think it all depends on what choices you've made early on. So if you are of the FIRE camp and you want to retire in your 40s, you have to. It's all about whether you've made the right choices to start with, and that does take a lot of sacrifice in your 20s and 30s. For a lot of people nowadays, youngsters nowadays, they're not going to be able to do that. The cost of living is so high that you cannot put as much as you'd like to put away towards retiring and saving. So that's the big challenge that we have now.
I assume if you are doing this hybrid retirement plan where you do continue to work, you need to start being clever about the tax situation, because there will be, your income's taxed, but then you need to start bumping up your income from other sources as well, and trying to stay within the sort of tax, a low rate of tax really is what people aim for, isn't it?
Yeah, the ideal is that you're a higher rate taxpayer, you've earned good tax relief on the way in, the money going into the pension has received good tax relief, and then most likely you're a basic rate taxpayer and you can play within the basic rate band. So you've got your state pension that's obviously making up some of your income, and then using your pension to top it up to only taking 20% on the pension income between sort of the personal allowance and the higher rate band. So there are ways to do this, and I think it's a really good idea, especially to speak to a financial planner at whatever stage of life you might be at, because they will help guide you there. Whatever your plans might be, whatever your objectives are, they will work to help you achieve that.
Great. Now we've talked a little bit about this being quite a hard task to retire early, but there's plenty we can do to make it easier. Craig, you look at what people are actually investing in at various stages. What do you see people doing? How does it change? Is there a difference between age groups, that kind of thing?
Yeah, there are some. We do this index every quarter, the Interactive Investor SIP index, and we can see what people are investing in sort of broader asset classes, and also the specific investments. An interesting trend when people transition from saving into taking an income is that people tend to invest more in investment trusts, which isn't a huge surprise because of the income producing capabilities that they provide. An interesting trend in our most recent index was that for the first time for people in both decumulation and accumulation, that passives overtook actives. And we know that shift has been in train for many years, but and you would expect that to continue. But that was quite an interesting.
So why are passive investing? Why is it becoming more popular? I mean, these are investments that just produce the average of the stock market. They're not aiming to outperform at all, are they? So it's,
no. Yeah, aiming to track an index. I mean, there are a few reasons. One is the cost. The costs are low. And another is that the number of active managers actually beating the index isn't hugely usually high. I mean, I think there are a few more this year. But another one is people often want to keep things simple. But I think what you'll find in a lot of portfolios is there'll be a mixture. I mean, if you look at some of the most popular funds, then it may come as no surprise that the Vanguard Life strategies in there and its various sort of equity to bond weightings, they're always featured in the top 10. But then I think that's what people tend to do, is use that as a core holding and then look at other things that might be a bit spicier, a bit racier. So other common things include Scottish mortgage, investment trust fund Smiths, always been popular over the years. They're kind of mainstays. But I think you see often people using a bit of a mix and a match. But when it comes to core holdings, it seems like passives are the way to go for a lot of people.
So maybe the message has got through on keeping your costs low, because that can be a key tool in achieving your retirement goals. If you keep your costs down, then the fees don't compound up against you, basically.
Absolutely.
And the differences can be really dramatic over 30 years of investing if you keep your costs low rather than higher.
Yeah, I think that's what it's important to look at all the different cost aspects within your portfolio. The platform charge, the fund charge, any trading costs if you trade frequently. It's important to look at the whole thing. And it does not necessarily to mean that the cheapest is always the best, but it's something to keep an eye on.
Okay. Now, can we talk a bit about risk? Because I've seen a few surveys where younger people are going into their pension default fund. So they're offered a pension through their employer and they choose the one that's just offered to them. And quite often that is probably a good mix of equities and bonds, so high risk and then medium risk. But if you're in your 20s and you've got 30 years to invest, you probably should be going a little bit higher risk. And I think some people are obviously very, very cautious about their money, and maybe not. But in general, do we think people are getting their risk right?
Well, I think risk again is a very personal thing, risk appetite. But there are some sort of things to bear in mind, and one of the biggest is time. If you've got lots of time on your hands, then not taking enough risk can cause an awful lot of harm to your future. And I think that interesting with default funds is there's no universal approach. They're sort of different shapes and sizes. It's been a decade since I've given any kind of financial advice, but I remember looking at this was in the process of like rounding up people's pensions and looking at some of the ones that are from previous employment. And some of the default funds they were invested into had sort of like 35% allocated to equities.
Oh.
And when you're looking at that money could be invested for 3 decades or sort of more these days, isn't it? Because often people keep their money invested in retirement as well. So that money could be invested for the rest of your life. To have such a small proportion in the assets that are designed to grow more than anything else was worrying. And a lot of the time, the biggest worry was that they didn't really know. They hadn't sort of checked it. In a lot of cases, there's other things that they'd rather be getting on with in a way, wouldn't it? That's why they seek advice. But I think if people can take the time just to look at it and just to look at your current default fund, the funds of any other investments that you hold, especially if there's significant amounts of money in there, they can make a big difference.
Lots of us leave our employer and move on to something else and leave the pension invested and forget about it, don't we? So
I just wanted to add, just when Craig was talking there, we've done some research that we do periodically, and one of the questions we ask is my pension invested? And only about 40% of people say that it is.
Oh.
And it feels weird to say this, in this kind of event, where people will be overwhelmingly investors and know that they're investors. But it's one of those things that auto enrollment has been an amazing thing because it gets you into the pension. But as yet, we've still got so much work to do to tell people what that pension is. Do you find that?
It's the financial literacy side of things, isn't it? People come out of education, but they haven't had any financial literacy training or any education on that front. So the auto enrollment, like you say, it's been a really, really good thing, but it's also led to complacency with a lot of people not looking at their pension, not paying enough attention to what's going in, what it's invested in. It's a real problem. And like you say, the fact is that the younger you are, the more able you are to take risk on, and that's the time that you want to be taking on a lot of risk in your pension. But people think the natural default is to think, this is my pension, I've got to be safe with it, when you should be thinking about your age profile and investment time horizon more so than just the fact that it's your pension. So it's really, really important. But yeah, not enough people are doing it, and not enough people are sort of paying attention to that workplace pension scheme. So I think it's one of the biggest things. If you want to retire early, do not ever opt out of your company pension scheme. It's the worst advice to give to anyone is to opt out. That money that your employer pays into your pension is effectively free money. You pay money into the pension, you get tax relief on that. They put money in, that's extra money that's going into your pension pot for your long-term growth. And if you're lucky enough to have something like salary sacrifice as well, you are benefiting from the national insurance saving that your employer makes as well. So, do not ever, if you want to retire early, the first thing to look at is, are you maximising what amount you are putting into your company pension scheme? If you're not, do it.
Yeah. I'm glad you mentioned salary sacrifice, because that is a thing that a lot of people don't know it's available through their employer. They might be at their maximum earning capacity and have got a big promotion or a bonus or something, and they could be putting that into their pension, and it can be really advantageous. Could you just explain it a little bit, Malvee?
Yeah. So the way salary sacrifice works is that you are putting in some of your gross salaries. You take a bit of a hit on your salary, so the number that comes into your the actual salary rather than your net salary. You take a little bit of a hit on that, but your employer puts money in as well. They save money by putting more money into your pension because it's classed as a business cost, and that cost means that they pay less national insurance. And that national insurance saving that they're making by paying into your pension is what they pass on to you as well.
And employers are a lot keener to do this now because they've all got national insurance problems now. So it's probably worth having that conversation, particularly if you're coming up to closer to an age you want to retire. Let's talk about how much is actually enough, because this, everybody has a number in mind, and I think that puts a bit of pressure on us as well. And the industry actually produces some numbers to try and help you with your thought process around retirement. Helen, could you talk us through those?
Yeah. So they are what we're known as the Pension Lifetime Saving Association's Retirement Income Standards. They're now known as the Pension UK Retirement Income Standards. And what they've tried to do is put a pounds and pence figure on various retirement lifestyles. So they've got minimum, moderate and comfortable. And minimum for a single person, they put as you would need to spend £13,400 per year, and that would give you, your basics, your food, your clothing, your bills, maybe a couple of little extras on top. You've got the moderate, which would maybe which they say will cost just under 32,000 per year, and that's covering all your basics. A holiday, I think you get 2 weeks somewhere in Europe. You can maybe rent a car, a few days out here and there. And then you've got the comfortable retirement standard, which is, as you say, a bit more luxurious, a few more trips to the theatre, this, that and the other. And again, for a single person, that's more like £44,000 per year. Now, this is really, really interesting because it brings loads of debate, because people go, no, that doesn't make any sense. Because for some people, they're like, okay, brilliant, it's a great rule of thumb. It starts the conversation. But so many people come to me and gone, I don't need anywhere near that amount to live the lifestyle that I want. And it's because your lifestyle is very singular to you. And what I like about these standards is that it starts the conversation where you think, well, what do I want my retirement to look like? What age do I want to retire? How do I want to spend my time? For some people, it's going to be loads of travelling, great days out, taking up the grandkids. For others, it's something a bit more modest, and it's important to start thinking that through and then kind of saying, well, what is that likely to cost? And then having a look at your pensions in the round, making sure that you've tracked down old pensions from old jobs that you might have lost track of, see what you've got in the round, see what that's likely to get you, and then you've got a plan, because you might find brilliantly if you're on track. If you're not on track, you've hopefully got time to do something about it so you can hit your retirement goals, whether that's retiring early, you might have to put it back a little bit. But what I will say with these Pensions UK figures is that they assume that you've paid all your housing costs. They assume that you've paid off your mortgage. And what we do seem to recognise more and more these days is that people are hitting retirement. They're either still paying off a mortgage, so they're bringing those costs into their retirement years, or they're still paying rent. And so that's a whole issue in itself that will impact how much you need to save.
Yeah.
Retirement isn't linear, is it? That's the thing we find with a lot of clients, is that, if you do want to retire at 60, 65, you've still got really good another 10, 15 years of good health, and therefore you might be spending more than what you're spending now. And that's a real challenge as well. It's that you might be doing a lot more trips to the theatre, weekends away, bit longer breaks. You might have kids that are still finishing education, so there are still a lot of costs in that early retirement. So it often ends up that you're spending more at the start of retirement and less as you go further on.
I think some advisors, I don't know if you do, Malvee, but they talk about the retirement smile. So you get the need for the early retirement big spends on all the fun stuff, and then a sort of slower period in the middle, and then the potential for it to be really expensive at the end. And of course, this is the rainy day that no one knows whether it's actually going to come. Are you going to need a very expensive stay in a care home at the end of life? And some people will plan for that and factor it in and have a big sum waiting, whether it's an earmarked bit of their pension or an ISA or something like that. But others will just think, if it comes to it, we'll have to sell the house and the kids don't get their inheritance. So there are lots of different ways of planning for that. So, what's come through in your survey and your research?
I was going to say, one of the really tricky things is when, whatever age you retire, whether it's 55 or 60 or 70, is the unknown future variables from that point. Yeah. You don't know what's going to happen with stock markets. You don't know what's going to happen with, I think the cost of living crisis a couple of years ago, the impact that's had on people's retirements, whether they've been having to return to work, people delaying their retirements, and we know that's been happening because they're not sure that their money's going to go quite as far as it was previously. So that's the other task, and I guess there are. When it comes to choosing, the types of income options in retirement, there are ways of guarding against it, but it just makes it that much tougher, that much harder.
I'm a bit of a stalker on a Facebook group called the Epic Retirement Group, which I find really interesting. It's got people from all around the world. They give each other tips all the time. And one of the questions recently was, what were the unpredictable spends that came up in retirement? And all sorts of crazy stuff. But most common theme were things like, I hadn't factored in that I could get a huge bill for my car every now and then, or the roof might leak, or these kind of, as you say, the variables. And it is probable that we will need those sort of spends at various times, and you probably do need some kind of slush fund for them. So really good to think about what's the possible. The other great tip that I saw was around trying out the retirement income to see whether it fits you. So like having a test run of it for 6 months while you're still earning an income, just see what that lifestyle looks like before you actually hand in your notice or write down your business or whatever you need to do to make it happen. So how much, we talked about the income levels, which were, remind me again, the three were?
So it's minimum moderate,
Yeah.
and comfortable.
And the figures were?
That is 13,400, 31,700 and 43,900. They are all for single people. There are different figures
And
for married.
they're taxable
These are
incomes, aren't
before
they?
tax,
So
yeah.
what do we need in terms of the actual big pot to get there?
Wow.
Do you know?
Okay. No, I did look this one up again for a single person. For the minimum one, just because it's just a little bit more than the state pension, you're probably looking at a pot of between 20 and 30,000. These are ballpark figures, by the way. For the minimum one for a moderate for a single person,
It's 200,000. 200,000?
No, it's more like 300,000. Yeah,
okay.
Yeah, and then for that comfortable one, it's 550 to 800,000. This is if you're
Right.
buying an annuity. There's all kinds of variables here. If you're married and there's two incomes, obviously you both need to have less saved. But it just puts figures in your head, so you can start to think, well, actually, what does this mean to me? And do I need to be saving more?
So you mentioned annuity. We should talk about how you convert your pension pot to an income in the end, because there's lots of choices there. There's not necessarily a lot of guidance on this. There's a lot of guidance on growing your money out there in the industry, but there's not that much about converting it to an income in the end. And the main choices, Malvee, maybe we should go to you on.
So you can use your pension fund to simply use flexi access drawdown. I think the great thing is that there is so much more flexibility around your pension pot nowadays.
And that's just taking the money out.
That is just taking money out. So remember, for most people, 25% of your pension pot is tax free. The other 75% is taxable at your marginal rate. So you could simply draw down, however much you need, whether that's 13,000 a year or 25,000 a year. Remember, you're going to get taxed on some of it at least, and you can just keep drawing down on the pot. And the other way is to use some or all of the funds to buy an annuity, which will give you a guaranteed income for life. Now, annuities of sort of in 5-10 years ago just were massively declining in popularity. It just wasn't. It doesn't give you a lot of flexibility, because if you die, that annuity pot that you've purchased dies with you a lot of times, unless you've got some sort of spouse guarantee there. But nowadays, that you don't have to annuitize your whole pot. That's the great thing. You can do it in phased amounts. You can start retirement and annuitize 200,000 of your pot, and that see what level of fixed income that provides you, and then you can also do it again in 10 years time later on to see if you need more secure income. The choice, there's so much choice out there, and again, I'd say speak to someone about your personal circumstances and what the right thing is for you.
And most people end up doing a mixture of annuity and drawdown in the end.
Yeah.
But I've spotted a recent trend as well that a lot of people start talking about. It's instead of an annuity, people are buying gilts. So these are loans from the government. They pay decent rates of income and it's guaranteed. And I think on Interactive Investor, they've been a lot more popular, haven't they, among people investing?
They have, yeah. We've seen an increase in direct gilt purchases.
Yeah.
There's been some, it's been over the past, or over the first quarter, there's been, we've seen investors taking a bit more of a defensive approach with things. I mean, that's probably in response to markets, some of the noise before the tariffs, and then obviously when the tariffs occurred and markets dropped. So buying gilts has been one. Another popular approach is to buy money market funds.
Yeah, so these are all lower risk things you can do that give you income, basically.
So that's what people are looking at, so that they can still keep sort of access to their money, so that they've still got some flexibility to access it in the future. Because with an annuity, you swap your pot for a guaranteed income for life. I mean, there are different ways of doing it, and for some annuities will be the right thing. Others will be happy to keep things flexible. But again, going back to what Malvee says, it's the options there. There's the flexibility for people.
Brilliant. Well, panel, you've been really great. We've covered a lot of ground. I'm just going to ask you all for your top tip for retiring early. Helen.
Okay. I would say keep track of how much you've got and think about how much you need. So I've mentioned those Pension UK figures. They're a great starter for 10. You might find it's better to say, well, I won't, that doesn't work for me. Maybe I might go with 2/3 of my income going to what you were saying, try that lifestyle before you retire. Just take that time to think about what you need, then you can put a plan in place to get yourself
Brilliant,
there.
thanks. Craig?
Mine's very simple, is to think about, set yourself a target income, a target age to retire, and then work towards it, start saving and investing towards it as soon as you can.
Brilliant. Malvee?
Mine is the company pension. It's the most overlooked asset that people have. Definitely go home tonight, have a look at what you can get and what the options are, and use it, maximise it.
Brilliant. Thank you very much. And if anyone wants to hear more about inheritance tax and pensions, there's a session at just after 3 o'clock that I'll be hosting again. Thank you.
Thank you.
Thanks very much to the panel.